Hi, my name is Roger Schluter. Today's video is really on the conventional small business loan. With all the talk of SBA loans, sometimes we forget that banks make what we call conventional business loans. They make them every day for small businesses and large businesses. When you go into a bank to get a business loan, you should be looking for a business loan, not an SBA loan. If you go into a bank and say that you want an SBA loan, I guarantee you they're going to think something's wrong with it. And the reason is that there's a big difference. Usually, when they do SBA loans, they do it because there's a problem. So when you say, I want to get an SBA loan, they're thinking, unless it's a 504 loan, they're thinking something's wrong. The exception is the 504, because 504 has some benefits for the borrower and the bank. So it is a loan for really good growing businesses. But I tell you, most of the other loans that banks make, I mean the conventional business loans, they're making them to good companies, and they're not gonna, there are certain qualifications for that. The conventional business loan will be made by that bank. They don't need anybody else to approve it. And then they're not going to sell the loan. They're not going to sell it off to an investor. They're going to keep it in that bank. That's an asset of the bank. So anyway, the approval should be fairly quick. On a conventional business loan, usually the approval is like a week or so. The approval process will take place at the bank that you're applying. Usually you'll have a loan officer assigned to you, if it wasn't a loan officer that brought you to the bank in the first place. If a bank sees a problem with your loan, that's when they're going to inform you that they're probably going to look into an SBA loan for your business. A problem with a loan would be usually declining sales or earnings, little or no collateral, little or no cash to put down as equity for your loan, and there can be other reasons. A conventional business loan will have the following attributes. 1, growing sales and growing earnings. Number 2, equity built up over the last few years or over many years. Number 3, collateral that you can pledge for the loan. Number 4, cash equity, cash that you can actually put down on the loan. Terms for the conventional business loan will be a little bit different from an SBA loan. Number 1, cash equity. They're going to want cash equity of at least 20 to 30%, sometimes more. They're going to want collateral to pay off the loan if you cannot. Has to be over 1-to-1. The collateral, one times the value of the loan that you're trying to get. And usually they're going to get as much collateral as they can. So a lot of people say, well, why do you need 3 times the collateral? Well, banks, they just want to feel comfortable with the loan. Interest rates. Usually the interest rate will probably be low. A lot of times it's a variable rate. It'll move with prime. Banks don't like making loans and then, for a couple of years and then all of a sudden the rates go up. So they usually like to make them where they vary with prime. They move with prime. Sometimes you can get a ceiling or a floor on those. You're going to want the ceiling. The bank's going to want the floor. And that would be like if you had a ceiling, let's say rates right now are like 5%. So you had a ceiling of 7 or 8%. It couldn't go above that. And then a floor, usually if they're going to put in a ceiling, they're going to say, okay, if rates are 5%, we're going to put a floor of 3. So anyway, that's what floors and ceilings are. They're going to want at least a 1% fee. Usually there's also a loan origination fee. The 1% is just a 1%, fee for doing the loan. And then a lot of times the loan origination fee can be anything from $50 up to $500. And a lot of times it may depend on the amount. If it's a small loan and they kind of try to hit you with a pretty large origination fee, you can go to them and say, hey man, this is kind of, this isn't quite right. And they would probably lower it. Terms are not as long as SBA, and maybe a couple of these things are reasons why people want an SBA. But the terms are usually like 1 to 2 years on inventory and accounts receivable. Banks don't like to go too much over 5 years for equipment or furniture fixtures. And then they, real estate, they'll go 15 to 20 years. So anyway, the bank will never want you to be late. You can't be late for a payment. I mean, even 1 day late is late. So anyway, and they really don't want you to miss any payments. If you become 1 to 15 days late, the loan officer is probably going to call you and say, hey man, you got to make this, you don't want to be on the 30-day late. And then if you are on the 30-day late, you really don't want to be on that list, because that's like the, that's all the bad loans that go 30 days late. And then if you end up on that list too many times, kind of bad things can happen. And not really that bad of things. I mean, it's not like, they're going to send somebody for you or something. But anyway, number one, if you're on the 30-day late list too many times, they may just ask you to find another bank. That'd be one of the things. Now, if your loan is coming up for renewal, let's say you did a real estate loan and they only, fixed the rate for 3 to 5 years, and it's like a 15 or 20 year amortization, then all of a sudden at the end of that 3 to 5 years, if you've been late a lot, they might just say, hey, we don't want to renew this. And then they would give you some time to go find another bank. But they can just say, hey, we're not going to renew it. You need to either find another bank or pay it off. If you're in default, that's kind of one of the worst things at a regular bank, and especially with a conventional bank loan. And that's why a lot of times the bankers want to take a lot more collateral than they feel that they could probably get away with. The reason is they're in default. They're going to probably talk to you first, but a lot of times they'll just immediately go ahead and start liquidating the collateral that you gave them for the loan. They can do this in several ways, but you may stop them. They could go to court, but banks don't lose money. A lot of people think that the banks are risking their capital. Banks aren't risking their capital. Banks get their money back, and they need that money back. Be able to lend to the other guy down the street, or lend to your friend, or lend you more money. So anyway, banks make good loans, and they secure them well, but it's a cheaper loan. You get a cheaper interest rate, and I guarantee you there's less fees, than you would on an SBA loan. Anyway, the conventional business loan with a local bank, they're really not that hard to get. Approval will be simple, and it'll be easy to understand, and it'll be at a good interest rate also. Points and fees will be low compared to SBA loans, and this is your choice. But I tell you, I'd try to get a conventional loan if you have the down payment. And that's a lot of times what decides. I mean, when they're talking at least 20% down, or maybe even more, 30% or so, that could be tough, putting down that much money. But I guarantee you, it will be a cheaper loan. It'll be a cheaper because you'll have cheaper interest rates, and it'll be cheaper because you will have less fees. So, and then plus you'll have a bank who, is there for you. They'll be there to lend you money in the future, and no matter what your needs are. So, and then they can do different types of loans too. Not that a bank that does SBA loans, but banks that do SBA loans tend to do the ones they can sell off in the secondary market. Banks, when they do a conventional loan for you, they're trying to help you do the best they can to meet your needs. So they could give you a line of credit at one point. They could lend you money for a new building at one point. They could lend you money for a new truck or some equipment for your business. So it's very easy for them to go ahead and make different types of loans. And as long as you pay them off, and as long as you're not late, usually they're very amicable and very easy to lend to in the future. That's all for this video, but I would say give the conventional small business loan a shot with your local bank and you might be pleasantly surprised. If you like business topics and you like talking about loans and different things in the business world, please go ahead and subscribe and hit the notification bell to get future videos. If you took something away from this that you think you can use, I hope you'll go ahead and use or hit the like button. So anyway, that's it. Thank you very much, and I appreciate you staying this long, and I'll see you in the next video.